Happy FOMC Day. My name is David. I'll be one of your co-hosts. And today, like every day, we're coming at you live from our studio in Las Vegas, Nevada. We have our FOMC special show today. All things the Fed, all things the banking crisis, all things what does it mean for crypto? What does it mean for macro in general? We have two very special guests joining us, Caleb Franzen from Cubic Analytics. Also, we have Magic Internet Money. They will be joining us soon to discuss, to extrapolate, and to figure out what the hell we're going to see and how the markets will react. But first, here is your other co-host, Robin.
Hola! It's your boy, Big Rob, back in the house. Welcome to Sin City Crypto. If it's your first time checking us out on our Fed rate special, man, oh man, we got a packed show. We got multiple guests. We got a pivotal moment. First of all,
I can argue in history.
Yeah, I mean, this is one of the most important shows we're ever going to make, right?
100%.
And
this will pave the way for what to expect the rest of the year.
Mm-hmm.
And so also stay tuned. We have a little quick 3-minute video for you. If you're not familiar with the history of the Fed and what they do, we're going to play that in a little bit. But, you know, we got to start off the day with some giggles. And so, Robin, we're both married. We both had girlfriends. You watching, you might be married, significant other. And what always happens when you go out with your wife and you say, hey, what do you want to eat? I'm not too hungry. Right? And then what ends up happening, Robin?
Well, you know, I've been in the service industry. A lot of times, you know, you get somebody that's excited to have dinner and then, you know, the lady just gets a salad.
When she really wanted a burger, some fries, steak. Well, there are restaurants that have significantly will help with this issue. Here is one of them. So you now have an option when going out to this restaurant. Not sure what the restaurant is, but if we find it, the name will tell you. There's a My Girlfriend Is Not Hungry option for $4.25. It'll add some extra fries, fried chicken wings, and some fried cheese steak. Or just
like you choose one. It's not all three. It's an or.
No, it says.
So you get extra fries, and then you get to add chicken wings.
You ain't pay no $4 for some extra fries. Yeah. Or it's like you're leaving the house. Hey, babe, you should probably grab a jacket. It's cold. I'm not cold. And then you get out there. I'm freezing. Then you got to take your jacket off. And
I'm in the camp. Like, I'm going to order my food. You want some of my food? You know what? Go ahead and order it. And just tell the server to, chop, chop.
In all honesty, to be fair, it should be another voice that say, my boyfriend is cheap. $4.25.
That is
there
very
are
true.
some cheap boyfriends out there. I've seen it.
He's like, can I get the filet? Babe, it is $45.
I'm sorry, but that's the worst. Like, it's just, you're serving a table and the lady's like, I really want a steak, babe. Can I get a steak? Like, if my wife ever did that to me, I would walk out and say, all right, we're leaving. That's unacceptable. You don't ask me permission to order what you want. If I take you out to a restaurant, you order whatever the hell you want. Also, interesting, Robin. And so I went through and read the entire crypto section, the digital asset section of the White House's new economic outlook. We're not going to go over that today because today's FOMC day, but I do want to share something interesting. This is how much they know. This is directly from the White House's paper. Despite Ethereum's switch to proof of stake, Bitcoin has not announced plans to make a similar exchange. I could have swore, Robin, that Bitcoin did make that announcement. I could be wrong, but didn't Bitcoin make that announcement that they were switching?
I might have missed that that memo, but I don't know. What have they announced lately?
A bunch of BS. Yeah. This just goes, after reading the whole thing, it just goes to show the lack of understanding and the complete bias against crypto in our space. This administration does not like crypto. Who knows? The next administration, whether they're Democrat or Republican, they might talk a big game prior to the run-up. They win the House, the White House, and they do the same thing. Who knows? But one thing is for certain. It is a direct competitive threat to their current crappy financial system, and they can't sit there and think that they can't sit there and let it overtake.
I feel like people in Washington are waiting for the Q4 report from Bitcoin, right? Like we're still waiting for the quarterly report.
Bitcoin,
guys.
You got to come in and register with us. Funny. All right. On to some not so funny news.
And also, I will say, if you are new here, say hello so we can jump an hola back at you. We do have a few new people here. We have Adonis. We have Anton. Also, Ultimo, Luke J. Poole, and Wolfman 8 My Crypto. To all of you, hola! Welcome to Sin City Crypto. Also, Matt Richardson has just popped up as well. So glad to see you join the party.
Hola. What's up, Matt? Hola, everyone. All right, some potentially harmful news. And if you live in the UK, this sucks. And here it is. UK inflation rate breaks the 3-month stretch of declines with a surprise rise to 10.4%. So we've been on this down trajectory, not just here in the US, but over in Europe as well, in the UK. And here we have it. It's now reversed. A lot of people have been saying this is what's going to happen to the US because of all the capital injection we've just seen over the last weekend from the Fed, from the Treasury Department, backstopping these banks. Robin, this is obviously of concern. I know you feel that way. I'm not going to ask you that question, but what I am going to ask you is, are we going to see something similar to this here in the US? And will it be like the 70s and 80s where they stopped too early and then inflation just skyrocketed again? What are your thoughts?
Let's see. How do you get a rise in inflation where all of a sudden, month over month, you reverse direction, right? I mean, doesn't take someone with a economic degree, right? It's pretty simple. Print more money, you get more inflation, right? That's kind of how we got into this mess. No surprise. There are other factors, supply chain, supply and demand, can drive up prices, can mess with inflation. But at its core, at a fundamental level, more money in circulation, less purchasing power, and more you got to put up to buy an item. Hence, you get inflation. And what the hell did we just do the last 2 weeks? We printed $500 billion in 2 weeks. Let that sink in. We printed $500 billion in the span of 2 weeks. 2008, it took us 8 months to print $1 trillion. Here we did it in 2 weeks. $500 billion at least. So will I be surprised if we follow in the footsteps of higher inflation? Same thing that we just had there in England? Absolutely. 100%. I would be surprised.
Does that scare you, Robin?
So I would be surprised. I'll put it this way. I would be surprised if our CPI or measure of inflation comes in lower every month for the next 3 months. I'll be surprised if that happens. I think because the numbers are lagging, I think we'll probably still get a drawdown next month. But after that, it's all fair game. There's no telling where these prices are going to go. Takes a while for this money to play through the system. Maybe it'll take 3 months. But I'm telling you, by the end of 3 months, we're gonna go a different direction when it comes to inflation. That's my prediction. So,
isn't it kind of scary to think the financial situation we're in now? We're probably going to need more injection from the Treasury, from the Fed. Their balance sheet, and we have metrics and charts to show you their balance sheet and how much it's increased. But what can they possibly do if they continue to raise rates? We've seen the cause and effect of that. If they stop, inflation has not come back down, and in the UK, it's actually reversing. So is there an answer? Is there a correct answer to what the Fed should do? Robin, is there a correct answer? And I know we're not bankers here. We don't have the expertise that Jerome Powell has or anyone in Congress has. But just from a common sense perspective and understanding how the Federal Reserve works, you kind of got to pick one or the other. You either pick high inflation for a little longer until the economy settles, or you let the economy just come crashing down, which we should have done anyways. I feel like as the years go on, the Fed gets more and more and more control and more hands on the economy, which is not what it was meant to be. It was not meant to boost the economy or bring down the economy. It was meant to keep the dollar strong, and it was meant to help.
It was meant to adjust interest rates for borrowing, basically the wholesale rate between banks, and to keep an eye on unemployment and try to keep unemployment from getting out of control. Now, where we're at, essentially the Fed drives the markets, right? The markets, S&P 500 or NASDAQ, hey, traders, even crypto, I mean, your gold bug, everyone is watching to see what move the Fed is going to make. Now, their role is no longer setting the wholesale rate for borrowing. They are in charge of printing, quantitative easing, injecting capital into the markets, buying up corporate debt, bailing out banks. You know what? I have zero doubt in saying it. The Fed chair position has tremendously more power than the president of the United States.
Can you really say that though? If the president is the one who elects, well, not
in more broader decisions with the U.S., obviously the Fed can't determine if we're going to go to war or not. However,
no, with monetary policy, I 100% agree with you.
Yeah, and not even monetary policy. I'm just talking about economics, GDP, banking, like the infrastructure, and all of that ties into, going to war and having military budgets. So, at the end of the day, like, where are you going to spend your taxes? I mean, a lot of this also comes down from the decisions the Fed has. What is your budget going to look like? Where do you have to cut spending? And so decisions that the Fed makes could essentially impact military dominance, right? How much money we can spend on the military. Because if they get reckless on their spending, have inflation, they have I'm just saying that I think more impactful, powerful position is with the Fed. Now, the presidential seat, they have checks and balances. There's other branches. There's other party, other elected parties, Republican, Democrat, the Supreme Court.
The Fed
they all like kind of there's supposed to be checks and balances, and it's a little out of balance lately, but they essentially keep an eye on
no checks and balances in the Fed.
No, it's literally up to one guy. And he proposes a vote with the other Fed members, but he can do whatever he wants. He can take into account, the other Fed members. He can take into a vote. Obviously, he's not going to blatantly ignore them. But at the end of the day, if he wanted to, he could. Right?
I spoke about what the Fed was originally created for. So we have a short video for you guys who want to know a little more about the history of the Fed, where it came about, and where we are today. We have a special treat for you guys. So here we go. Please enjoy this video. President Woodrow Wilson signed the Federal Reserve Act into law on December 13, 1913, after the Panic of 1907 forced the government to look to wealthy investors like J.P. Morgan to bail out the public. Although the Fed currently serves as a conductor of monetary policy and maestro of our economy, price stability, max employment, and interest rate maneuvering were part of the original Federal Reserve's duties. They were created simply to make the American banking system more stable and improve the flow of money, which in turn will put the American public at ease in regards to their money being safely held at their local bank. Fast forward over 100 years, and we now have arguably the most powerful entity in the world with the power and capability to sway not just the American economy, but the global economy in its entirety. The Federal Reserve System consists of a chairman, vice chairman, 5 board members, and 12 district presidents spanning across the continental United States. This group of individuals are referred to as the Federal Open Market Committee, aka the FOMC. They meet 8 times a year to discuss and vote on monetary policy. The Fed has 5 main objectives: manage inflation, promote maximum employment, supervise the banking system, maintain the stability of the financial system, and provide banking services. Over the past 12 months, the Fed's main focus has been to get inflation under control by increasing the federal funds rate. The federal funds rate, also referred to as the FFR, is the baseline rate that banks use to borrow and lend money to one another. The FOMC has the power to vote to either increase or decrease the FFR, which in turn increases or decreases borrowing costs to consumers. Here's an example. The Fed increases the FFR by 50 basis points, or 0.5%, which makes it more expensive for banks to borrow money from one another to cover liabilities and meet reserve requirements. This in turn causes what's called a ripple effect, where banks pass that expense down to the consumer, aka you. They raise the interest rates on your credit cards, personal loans, car loans, and home loans. This tactic of raising the FFR is so the Fed can siphon money from the economy, which decreases spending as borrowing to purchase goods becomes more expensive, which has a direct impact on prices, aka inflation. The idea is to quell demand, suppress inflation, and stabilize prices. What kind of impact has a higher federal funds rate had on the economy thus far? Let's talk about it. But first, before we talk about it,
let me give a quick shout out. We do got 240 people in here, or 250. So glad to see the turnout. However, we only got 90 likes. We're like a 25% like ratio. I don't know if my math adds up there, but that's what I'm going with. Anyways, guys, if you like our special today, if you like Big Rob and Little Dave, hit the like button.
You know I'm bigger than you, right?
Shut up. So,
More ways.
Ask yourself this. Have you hit the like button? If you're not, hit that damn thing. Also, if you're new here, say hello so we can drop an hola back at you. We got HVAC Dave, Crypto Petro. We have Diana Laka, also Hazley, Nighthorse, Crypto Trucker, Verderi, Crypto CT, and J Pool. To all of you, hola! Welcome to Sin City Crypto.
I am super excited to bring our first guest on. If you're not familiar with this young man, his name is Caleb Franzen. He runs a Substack, Cubic Analytics. He's been called on other channels the young Charlie Munger, and I know a lot of people look at Charlie Munger, but the dude's a genius. Whether he hates Bitcoin or not, calls it rat poison. And so Caleb's insight into the world of banking and macro and economics and treasury yields is bar none some of the best in our industry. So we are extremely excited to have him join us today for this FOMC special. So without further ado, Rocco, let's patch in our friend, Mr. Franzen.
What's going on, guys?
What's going on, brother? How you doing?
Doing very well. Pleasure to be on here. Really excited. FOMC day always gives me the jitters. So I'm tingling, man. I'm tingling.
All right.
I'm also tingling.
All right. I want to know, before we get into any charts, numbers, tweets, we going 25 or we having a pause? Where is it at? What's the gut saying? Where is it?
25.
25? You know what? I know the CME. Rocco, pull up my laptop real quick. I know the CME says
25.
25. There's an 86% chance here. I'm just saying that I think this is going to be the first time the CME gets it wrong.
You think it's going to be a pause?
I think it's going to be a pause, man.
What?
I think there's just so much uncertainty in the banks. Now, I think I know I'm probably going to be wrong, but I don't know, man. I have a feeling we're going to get a pause, and then after in the press conference, they're going to make us say, "Hey, look, man, you know what? We're near our target range. Interest rates, inflation is coming down. We are prepared to raise. We're going to evaluate it month by month." But I don't know. I think a pause is coming.
Caleb, what are the impacts if they do pause, in your opinion?
I honestly think the impacts are going to be worse if they pause. I think that the market would interpret that as essentially saying or believing that the Fed knows something that we don't as a market, right? Like, everyone's seen headline after headline with the whole Silicon Valley Bank situation, Silvergate, SBNY, Credit Suisse, UBS, First Republic, right? So it's kind of already baked in, right? And as of right now, the Fed, the FDIC, the Treasury have been able to come in and intervene and essentially make depositors whole, right? We have not seen a run on the banks, even though this whole situation has kind of been unfolding for the past week and a half, 2 weeks, let's call it. And so if for some reason the Fed, pauses and the market interprets that as the Fed having to provide even more intervention or even more slack to the financial system, it might be interpreted as, what does the Fed know under the hood in its correspondence with these banks, and maybe having some insight into the JP Morgan situation with First Republic Bank, and having all these consultants come in. What does the Fed know that we don't know to cause them to pause here, right? Because the market is the market's going to interpret it that way. I promise. It might be bullish at first and see a little bit of an acceleration, but then I think the sell-off would likely come in thereafter.
I have an interesting thought here. I think this might be the first meeting, and I agree, it's more likely to be a hike. But I have this suspicion that if it's a pause or a hike, I think we're going to see a rally out of Bitcoin today. I think because with the hike, I think it puts more pressure on the banking system. The contagion that we're having right now that's playing through the smaller banks, perhaps that accelerates. And I think that, we got into the mess with the banks because of the interest rates. And now it's one step more leveraged up. One more, if we have a car jack, they've ratcheted it up a little bit more. And I think Bitcoin and crypto, it is in this short term, at least, decoupled from the markets. And so I think today, if we get an interest rate hike, we might see a pullback in legacy markets. But I'm telling you, I think even with a pullback in legacy markets, a 0.25 increase, I think we're going to see a rally in Bitcoin. I think Bitcoin gets to the 29, 30K
29, yeah.
today. I think we might see
Bitcoin
it,
kind of was flirting with 29 this morning when I woke up.
And at the same time, if it's a pause, obviously Bitcoin's going to rally as well.
So guys, I have some good news for everyone. For all of us on this panel and for everyone watching, I went through and I read the last FOMC minute from top to bottom, and I highlighted certain key factors, and I'm going to go through, read, we'll pause, we'll discuss. We are getting the rate hike announcement at 11 a.m. Pacific Standard Time, 2 p.m. Eastern Standard Time. So as soon as that is announced, we will talk about that, and then we will cover Jerome Powell's press conference live 30 minutes after the rate hike is announced. So let's go to last meeting's FOMC minutes. So why is this important? This is exactly what they talked about in that meeting. So a few things I have highlighted, and I will take strategic pauses and get your guys' opinions. So the first thing we're going to talk about, they said they placed significant probability on a target federal funds rate range close to 5%. A significant share of survey respondents anticipated that the committee would hold the rate stable for much of 2023. How much of that will have changed with the banking crisis? We'll talk about in a second. And then also about the extent of potential slowdown. Market participants interpreted incoming data as pointing to moderating inflation risk. Okay. Some other central banks communicated that they were at or near a point where it would be appropriate to pause policy rate increases and assess the effects of cumulative policy tightening. Now, I want to ask you first, Robin. So obviously, the central banks look to each other and see what they're going to do. You think the U.S. Fed is going to lead the pause or the cut or this, or do you think the countries in Europe are going to? We talked about inflation in UK getting back up to 10%. What are your quick thoughts on that?
Generally speaking, the Fed usually is reactionary. They don't set the tone. They wait for inflation. I mean, just look at recent history. They wait for inflation to get out of control to adjust the interest rate. They have always been behind the ball. And a lot of that is that they want to play it safe. They don't want to try to speculate and lead the market. And so when it seems like, hey, they have to do it, it's like it's obviously too, getting late in opportunity. That's when they pull the trigger. So I think they're just gonna look at factors. I mean, that's what they talk about at the end of all their meetings, right? Oh, we're gonna look at the data, and the data is already lagging by a month, and so they're always gonna be behind the ball. Now, I do think that this meeting might be a little different because they have more analytics and more data, and they see firsthand.
Well, they've seen
what
something
is happening.
broke.
Yeah, they see that the system is extremely stressed, and the banking system is extremely fragile right now. And not to mention, they just dumped a ton of quantitative easing and liquidity into the markets, and so they are seeing firsthand where they're at with the situation. So I think this might be the first time that they might be a little proactive instead of reactive when it comes to the interest rate hikes. And I do think they're not paying attention to what's going on in Europe, in my opinion.
Do you agree with that sentiment, Caleb? What are your thoughts?
Yeah, generally I do. I think, I put out a tweet earlier today saying, I think that the Fed is going to hike today. I don't know if that's necessarily the right decision. And, I know we've seen these, kind of failures / shutdowns. And at first, I think I thought that they were going to be more significant than they actually were, So I put out a note saying, kind of elaborating on my earthquake effect theory and saying, I put out a note the day after SVB got shut down. And, I called it a tsunami has formed, essentially thinking that this was kind of the first major market failure to actually threaten the underlying financial and economic system. But we haven't seen that yet, right? The Fed has been able to come in and intervene. And so, I think that they will move forward with 25 bips today. I don't necessarily know if that's the right decision, but what I did do earlier this morning is I put out a little just post on Twitter saying that this to me kind of feels like the opposite end of the mistake that they were making at the beginning of 2022, right? Because if we rewind to the beginning of 2022, the Fed in the first quarter was still basically injecting about $100 billion a month of liquidity into the financial markets. They were going out and they were buying treasuries and mortgage-backed securities, right? They had just started tapering in November, December of 2021. And then going into March was their first official kind of rate hike, And, at the time we had inflation well above 6% on a year-over-year basis for multiple months. And the Fed was still providing over $100 billion of liquidity into the market. That was a clear mistake. With hindsight obviously being 2020. And so I think today is going to be, the inverse of that, right? Because from my perspective, and this isn't my perspective, but, monetary policy operates with a long and variable lag, right? That's the classic quote from Milton Friedman back in the 70s and the 80s,
Yep.
Talking about how rate hikes take time to ripple through the financial and economic system. And so we're literally 12 months into this tightening cycle. We've seen, a massive deterioration in wealth and net worth in the United States. We've seen crypto crash dramatically. And amidst all that liquidity getting pulled out of the system, we've seen FTX, Three Arrows Capital, Celsius, Luna, BlockFi, so on and so forth. And now for the first time, we're actually seeing the traditional markets being impacted by the withdrawal of liquidity, right? And so this for me really kind of boils into this whole kind of earthquake effect dynamic. The Fed should be a little bit more forward looking here and recognize, hey, look, we've done the fastest tightening cycle in modern US financial history, not just US financial history, but financial history ever, right?
Yeah.
And so, that is going to take time to really have its substantial and full impact. And we've already seen inflation come down and moderate. It's still significantly way too high, but they've made substantial progress and there's still going to be a lot of tailwinds for disinflation in the months ahead based on my models.
I agree, man. And I think you're completely spot on. It's time to be proactive. And I believe my saying has been the Fed should have been proactive when a bunch of people got airdropped $1,400 when they couldn't spend it on anything except goods, right? They couldn't spend it on anything except sofas and TVs. They couldn't travel. They couldn't go to restaurants. They couldn't vacation. So there's this pent up demand and interest rates are low. At that point, you should have started slowly tightening 25, 50. And then, hey, when inflation starts going up, we're at a 2% target rate, or we're at a 2% effective federal funds rate. And now you can start going 50, 25, 50, and not just 75, 75, 75, destroy the entire bond market. But I want to go back to
real quick. Can we just get I want to know what the chat thinks. I know there's a poll up here, but I want to get real time data. Guys, where do you think the Fed is going to land on this interest rate? Do you think it's possible we're going to get a pause? Put a 1 in the chat if you think the Fed is going to pause interest rates, or put a 2 in the chat if you believe that we're going to get a 0.25 rate hike there as well. So I want to know what the feeling is.
All right, let's get back to the FOMC minutes. I have a few other things highlighted I want to share and get you guys' opinion. So,
my bad, guys.
Thank you, Rocco. Real GDP growth was bolstered, especially by a large gain in inventory investment and a notable contribution from net exports as imports fell more than exports. Regarding production, U.S. manufacturing output declined sizably in both November and December. All right? Going down here. Credit quality remained strong overall, although there were some signs of deterioration for consumer loans. Interest rates on existing credit cards continued to increase in recent months, and interest rates on new auto loans also rose through mid-January. So that's going to be an issue. Here's another interesting thing. HELOCs, home equity lines of credit balances at banks continued to grow through the fourth quarter on net, potentially reflecting homeowners using HELOCs as a preferred way of extracting home equity in the presence of high current mortgage rates. Banks reported tighter standards for all consumer loans. Even so, total credit card balances increased at a solid pace in November, while auto loans grew modestly. The staff provided an update on its assessment of the stability of the financial system and, on balance, characterized the financial vulnerabilities of the U.S. financial system as moderate. They also noted that measures of valuations in both residential and commercial property markets remained high, and that the potential for large declines in property prices remained greater than usual. Now, I have a question, Caleb. So, more people are accessing their home equity for obvious reasons, right? Inflation, whatever the case may be. Rates are going up. People are spending more money on their credit cards. Personal savings are going down. And now we're seeing large declines in property values. If you were to extrapolate this situation and say, looking forward, what kind of ramifications can this have on the housing market, on the mortgage-backed security market, in the credit market in general? What are your thoughts?
So, admittedly, I've been perhaps a little bit overly bearish on real estate, and we have yet to see real estate really have a substantial decline. I think we had a 2-month or 3-month period sometime in the third quarter of last year, and it was, like the fastest 2-month annualized rate of change to the downside in real estate prices since '08, right? So, it's a very niche data point, but aside from that, we haven't really seen home prices come down. The latest data that we have for December of 2022 is the Case-Shiller U.S. home price index, and I think that was still up on a year-over-year basis. It's obviously decelerating though, right? And so that's very key to note. The thing is, that's basically data that's 3 months old, right? So how accurate or reflective of the actual U.S. economy is it today, right? And so that's definitely important to note. The thing that's been very difficult with real estate, and this is actually something that I baked into my forecast, is supply and inventory is also historically low. Because funny enough, in April of 2022, I did this tweet and I said, fun fact, debt with an interest rate below 4% is actually an asset. And that's exactly what we're seeing, right? As those interest rates get to, I think 6.75% on the average 30-year fixed mortgage rate today, someone who has a mortgage rate below 4% is saying, why would I give this up, right? I'm going to have to get into a higher cost home because home prices haven't come back down. And my monthly P&I payments, principal and interest payments, are going to be super high because mortgage rates are significantly higher than where they were a year ago, 2 years ago, 3 years ago, right? And so that's the very big thing. And so if demand crashes, but supply is also declining because no one wants to sell in a higher interest rate environment, it's kind of like, your equilibrium point just moves to a lower supply, but your price is still the same. Right. So that's essentially what's taken place, right? So I would actually argue home prices have been very sticky. And we had a breather in interest rates where the 30-year mortgage started to decline, but now we're reaccelerating back again. And so I've been trying to think about how homeowners might think through this environment. I'm not a homeowner, so I'm not actually able to put myself in their shoes as well as I wish I could. But I still overall remain bearish on home prices, right? I have family members reaching out to me if they should be purchasing a home right now. I say, just give it another 6 more months. Let's see where monetary policy goes. Let's see where the economy goes. No need to rush anything, right? And so that's kind of been my, overwhelming principle across the equity markets, the real estate market, crypto, is don't rush anything. Just feel free to kind of sit back and let things unfold for a little while.
I agree. Rob, before I get Robin's opinion, I want to go to now, Caleb, you're very well versed in the bond market, in the banking sector. Rocco, can we pull up my laptop again? So this next segment is this next segment is talking about corporate bonds. So the volume of corporate bond rating downgrades outpaced upgrades in December. Measures of expected default probabilities for corporate bonds and leveraged loans remained elevated relative to their historical distributions. Delinquencies on small business loans continued to edge up in November. And so, Caleb, I'm going to ask you first. I'm going to get Robin's opinion. Do you think we're going to see something similar to what we saw in 2008, where the banks bailed out, where the Fed bailed out everyone? Corporate bonds, junk bonds, agency bonds. What do you expect to see if this was in November with these delinquencies and small business loans and downgrades of corporate bonds? What kind of ramifications would that have on the banking sector and what the Fed will do moving forward?
So those downgrades are accelerating 100%. That's first and foremost, right? That's the first section you have highlighted there. The second one is talking about default probabilities. And if we actually look at defaults, defaults are still very low from a historical perspective, but they're accelerating, right? So the defaults and delinquencies is once that starts to pick up and accelerate higher, the train has left the station. Right. So then it just depends on the pace with which they accelerate. But once you start to see delinquencies and defaults kind of bottom and then start trending higher, this doesn't stop until shit hits the fan. Right. Excuse my language. So that's the second point there. What was the third one? Are we able to pull that screen share back up?
Oh, yeah. Rocco, will you pull up? Yeah, perfect. Sorry.
Oh, delinquencies. Okay, so there was the second and third one combined there. Yeah, so those are my thoughts on that, right? So we'll see all of these aspects continue to deteriorate, and it's a no-brainer. This is exactly what happens in a higher interest rate environment when the economy's been hooked on ZIRP for the past 10 years, right? And it's like, we had that hiking cycle in 2015 to 2018. I think the effective federal funds rate only got to 2.5%, right? We're already basically double that today, especially once we get today's most likely 0.25% rate hike.
Rob, what are your thoughts? Are we going to see the Fed have to come in and bail out these small business loans that are maybe going to go default, or these corporate bonds if they start getting defaulted? Are we going to see a repeat of 2008?
I mean, quantitative easing is that. Well, and what happened in 2008 is they just took that fire hose and just sprayed it over the entire
everywhere.
Even
junk bonds.
Yeah, everywhere. They injected capital to anybody and every company that seemed like they had any bit of drawdown issues, problems, money, debt. Like it went everywhere. Now we're not there yet, but I mean, right now we're pouring money into the banking system, or at least liquidity. They're not hypothetically bailing out the banks, they're just bailing out the depositors. But I mean, essentially, it's pretty much the same thing, right? I mean, the difference is the bank CEOs aren't really cashing in bonuses, so that's probably the only difference. And we are seeing that banks can still go under with this injection of capital. SVB and Suisse is a good example. I know Credit Suisse is outside the U.S., but a pretty similar situation there as we're seeing here. So when it comes to retail credit, though, it's very interesting because I feel like the U.S. consumer's at a tipping point, right? The credit card debt is at a high for since the 2010, I think it is, and so
it started coming down during COVID.
Yeah,
and then it started going back up again.
Well, people weren't allowed to spend, they didn't have leisure and other expenses.
Here's the issue.
But the one thing to keep an eye out on, though, is yes, debt has gone up, but savings has been obliterated. No, the average U.S. citizen doesn't have any savings account any left. I mean, that has been just destroyed. And so that's my concern. I mean, what happens if we go into a situation where somebody needs to draw on, has an emergency situation, and so if something happens globally, man, I think there's no coming out of that.
I think the issue for me is not only consumer credit card debt going up because people have to offset high bills at the grocery store
and those auto loans too,
but the interest rates going up too. And so your credit card might have gone from 18% to 22% to 24%. And so if you were only making minimum payments, now those minimum payments have gone up and you're more in debt. And so I think we're gonna come to a head here soon. And people are just gonna start defaulting and say, screw my credit. I don't really care. I can't afford to pay $500 a month on this one credit card when only $50 of it is going towards my principal. And so that's going to be an issue for the banks as well. If you think a bank run and people trying to pull money out, imagine what's going on with the balance sheets where they're all these billions of dollars of unrealized losses from holding long-term treasuries. Imagine a bunch of defaults hitting the system at the same time. It's not going to be good.
Well, also one last thing I want to add there to just on top of that is that when it comes to drastic financial maneuvers, it's a lot of herd mentality to this. So you remember back in 2008 when everyone did the short sale on their house? You ever heard of short sale on a house before that? Right? It wasn't invented in 2008. It was something that was available, but as soon as the guy across the street did a short sale, then you're like, oh, I can do that. Yep. And then here we're going to see a situation where you're going to have cascading defaults, right? In the retail sector, someone's going to file for bankruptcy. And when you're at work and 3 people file for bankruptcy that you work with, and like, oh yeah, here's my lawyer's number. That herd mentality spreads. And so we haven't seen it yet, but I'm telling you, when this snowball starts rolling,
if 2 out of 5 people have declared bankruptcy and you thought it was cliche or you thought it was a bad look, you're probably going to be pushed to the same
exactly.
thing.
And then real quick, I just want to give a little shout out to the chat. We do have over 400 people here, so good to see the turnout. If you're new here, say hello so we can drop an hola back at you. Actually, while I do this, why don't y'all show the rest of the chat, everybody that's new here, what we do. Drop an hola in the chat. I want to see at least 300-400 holas in the chat. I'll lead the chart. I'll drop the first hola. And then, and as I said, if you're new here, say hello so we can drop the hola back at you. We have... This is a nice little list. Ahmed, REM, Crypto Bacon, SpongeBob, Nick, Steak and Earn, Rocket Jr., Carson, 208, DK Productions, Boo Boo. We also have Phoenix Street China, David T, and also David. We have Anthony, Edwis, Scott, Coach Dale, Havenly, Jacob, Magician, Sup Smoked, Joe S, Patrick M, CPL, Degen, and Burke with an E. Hola! Welcome to Sin City Crypto.
All right. Also, big shout out to Jimmy gifting 20 Sin City memberships. We did just drop a behind the scenes Sin City members only video, so go check that out. So just to wrap up the FOMC minutes, let's go ahead and finish this up. So the effect of large unrealized and this was, guys, remember, this was back in February. The effect of large unrealized losses on some bank securities portfolios. So they already knew this issue was out there. Okay. Few participants remarked that recent failures of companies involved in crypto finance have had a limited effect on the broader financial system. I can argue that the broader financial system has had more of an impact on the crypto companies. These participants indicated that this limited effect reflected the minimal extent of the crypto market's connections to the banking system thus far, consistent with the risks associated with many of these activities. Right? A few participants stated that they favored raising the target range for the federal funds rate 50 basis points. All participants agreed that it was appropriate to continue the process of reducing the Federal Reserve securities holdings. Now, this is interesting because down here, I got something else highlighted. Reinvest into mortgage-backed securities. The amounts of principal payments from the Federal Reserve's holdings of agency debt and agency mortgage-backed securities received in each calendar month that exceeds a cap of $35 billion. So I guess they were kind of letting it roll off their balance sheet, but kind of also reinvesting some of the money. QT is done, by the way. QT is completely done. And I'm going to pull up the Fed's balance sheet, and you can see why I'm saying QT is done. And you can see here, you guys, we peaked out April of last year at $8.9 trillion on the Fed balance sheet. Okay, you can see that meteoric rise starting in May of 20 or before May of 2020. Of course, it was COVID, and then you can see Yeah, there we go. You can see that little uptick again. That was that $300 billion that came in. That was a backstop, the liquidity for Silicon Valley Bank and Signature Bank. Now we're back up to $8.63 trillion. And we will be over $9 trillion in the next few weeks. There is zero doubt about it. Janet Yellen's already come out and said, hey, we are working on how to backstop and provide liquidity for every single bank deposit. On top of that, you had the Federal Reserve announcing that they're opening up liquidity swaps, liquidity lines for overseas central banks and overseas banks. So, Caleb, what are your just talk. I don't have a directed question. Just
happy to talk about this because the Fed balance sheet is probably one of the things that I pay some of the closest attention to. So you're right. They are. I would even go as far to say what they've been doing since last April has not been QT, right? Because what's QE? It's them going out into the market and buying treasuries and mortgage-backed securities from commercial banks. In this particular instance, what they've been doing since last April, so QT, the opposite of that is if they go out and they sell the treasuries and mortgage-backed securities to banks in exchange for dollars, right? So they take reserves out of the system from the banks, and then they give the banks treasuries and mortgage-backed securities. That's not what they've been doing, right? That's not what they've been doing. What they've been doing is they've been letting the treasuries and mortgage-backed securities on their balance sheet mature, right? Because a treasury or a mortgage-backed security is simply just a bond in its essence, right? And so those bonds mature. Hey, I'll give you $10,000 for the next and you'll have to repay me back in 10 years. And during that 10-year period, you'll also pay me interest. And then at the end of that 10 years, I'll get my, $10,000 back. And so what's happening is, let's shorten that duration back down. Let's shorten that maturity back down. And so maybe that's only 2 years or 3 years. And they bought these, 2-3 years ago. And now what's happened is they've gotten that money back and they're just, letting that asset roll off their balance sheet. And so that's essentially what's been happening. They haven't actually been going out into the market and actually selling their treasuries and mortgage-backed securities to banks, right? So this is why it's like super key for people who are watching this to understand this, right? Because what they haven't been doing QT, they've been doing something called balance sheet runoff. And it still has a net impact of reducing liquidity out of the financial system, right? But at a much slower pace than outright QT. And so what we've seen now with, the BTFP facility coming in is the Fed has now been able to inject $300 billion of liquidity into the market in a matter of like 2 weeks, right? Not even. And so they've essentially erased 4 to 5 months of balance sheet runoff because now their balance sheet is essentially equivalent to where it was in October and November of last year. So, we've had all of this, market volatility, if you will, over the past 4 to 5 months. Because the Fed was reducing its balance sheet. And now all of that has just been completely, mitigated and reversed. So it's like, how much of an impact, what was the purpose of it in the first place, right? Like, was the Fed intentionally trying to cause these duration risks to really come out and really impact these banks, right? Like you had just pointed out there in the minutes, they were acknowledging this risk, right? They were fully well aware of the duration risk that banks had on their own balance sheets. And now we've actually started to see some of these things actually roll over, right? They're belly up.
Yeah. I mean, are we going to see them open up the fire hose again? I think so. They're already doing it. It's just to what extent are they going to do it? Is it going to be as robust as '08? Are they going to have to? Who knows? But all I know is this wasn't what the Fed was meant to do. Guys got to remember, the idea of quantitative easing was introduced less than 20 years ago, 15 years ago in 2008. There was no QE. There was no let's put this on our balance sheet. There was no that's not what the Fed did. And here we are today. We have our second guest ready today, guys. If you're not familiar with Magic Internet Money, he is a charting specialist, TA analyst. He looks at order flows, Bitcoin. We're going to bring him in. We're going to talk about some price action. So let's go ahead and bring in our second guest, Magic Internet Money. Magic, what's going on, my friend?
How we doing today, guys?
We're antsy. We're like Caleb. We got, what'd you say, Caleb? You're
Tingly.
Yeah, baby.
Tingly.
We're feeling tingly.
Yeah.
The tingle is real. Now, Magic, first and foremost, thank you so much, my friend, for joining us. We've done this with you guys twice now, and it always comes out to be an absolutely amazing show. Now, Magic, I wanna go to you to Bitcoin. We saw Bitcoin get up to 29, almost 29K today. Almost 29K. It's back down to, I believe, 28.3, 28.4. What are you seeing on the lower time frames? Is there are we getting ready to move one way or the other? Like, is volatility just starting to kind of, is a rubber band being pulled as far back, and are we getting ready to see a big move either to the upside or downside?
I think so. We're at some pretty key areas on the chart personally for us, what we've been watching. And so I'll share my screen and talk you through it. And it's funny how that always happens at, days like FOMC day. The volatility is always primed for it. So in terms of what I'm looking for, I'm just going to start on the daily. Trying to keep it as simple as possible and just put as few boxes on the chart as possible. Main reason I've got this blue one here that we're in is this is going to be the one standard deviation from this range that took place back in the summer when we were dumping. That's the value area low of it. So you want to see yourself above it. Also, it's the low of your summer dump right here at 28.7, 26.50. And this level did offer up quite a bit of support when we were trading in this range, right? You did have two things that were pretty key coming into this region as well. You'll see that there's a couple different values in here. The 6M2 and the Q322, these are actually the averages of price for quarter three in 2022 and the second 6 months of price in 2022. Both had not been tapped, meaning that price had not reverted back to that average just yet. So it's something I keep on my charts, and then statistically we start targeting them not necessarily for support and resistance, but as just targets for like take profits. Okay, so you've come into this region, and if claimed, the big area I want to see is going to be this 30K psychological area. You've got some unfinished business up here from, again, the quarterly chart in 2022. You've left over some naked pointed controls, and you just have an overall structural right here. You can see this is where your structure on the high time frames, like a weekly, they started settling up before that final push down. So going to be a pretty important area on the chart. If claimed, I mean, to me, I would like to see a run of these highs. We were covering it this morning on our show. So I'm still looking for this secondary box right here. If claimed, we can talk about some pretty high valuations for Bitcoin, but I would like to see the high taken into the meeting potentially, and then maybe even try to fade that move. That's kind of what I'm looking for right now. You did have a little bit of volatility this morning, just some people getting involved before anything was going on. And that's always fun to trade, but those aren't positions I'd be willing to hold on to personally. I would be out of those as I am now, and looking to see if we can't get some volatility up into this 30K zone. If so, I think that's a very actionable area, both for upside and downside, because if you get the reaction we need to see, like a finished auction, and we have buyers getting trapped into this region, you'd be looking potentially to short it all the way back down to this blue box here, but potentially all the way back down to like 26.7 to 26.9 in that region, which is a nice move. It's a several $1,000 move. The only thing you can't do is marry the idea that this is going to be a good place to be putting on risk for shorts, because if it blows through this region, there's really nothing between you and probably the high right here coming in right around 32,392. And if you're trading with leverage or any kind of risk, that can definitely pose some problems. But yeah, that's how I'm trading today. That's the plan for today anyway.
Interesting. What's your and I'm curious to get Caleb's, like, if you were I'm live? Okay. Let me go like this. Hey guys, do me a favor. Put a 1 in the chat if we're back. We lost internet for a second, but we're back. We're back. And we're going to get our guest back on here in a second. But I saw Caleb post in there that a 25 basis point rate hike was announced. So let's take a look. Excuse me. Yep, there we go. Fed hikes rate by a 1/4 percentage point, indicates increases are near an end. Increases are near an end. So we're about to stop. What does that mean? Are we going to get to 5%? We're definitely not getting to the 6-7% Robin said. So I would like to announce myself the winner of that bet. I think we bet like 1 Bitcoin or something, but we'll settle that in a little bit. So this is obviously breaking news. The Federal Reserve on Wednesday enacted a 1/4 percent point interest rate increase, expressing caution about the recent banking crisis. Oh, sorry. I thought you were talking to me. Cautions about the recent banking crisis are indicating that hikes are nearing an end. Along with its 9th hike since March of 2022, the rate-setting FOMC noted that future increases are not assured and will depend largely on incoming data. Now, me personally, I think a part of this incoming data is going to be twofold. One is going to be unemployment rate. We saw unemployment rate stay at 3.4%, historically low levels, but last numbers came in and we got up to 3.6%. So if you remember Jerome Powell going in front of the Senate and the House of Representatives, Congress essentially, and they asked him, hey, if you continue to hike, and get to your 5 to 5.25 target federal fund rate, there's going to be 2 million people who lose jobs. Unemployment is going to go up to 4.4%. And so if that happens, right, we're definitely going to get a pause, but I don't think they're going to wait to see unemployment go up to pause. I think depending on how the banks react, and you got to look at it this way too, right? You injected all this capital into the market. And so if you pause or cut, you're kind of adding fuel to the inflation fire. So although there isn't 100% right answer, because we should have never been in this predicament to begin with, as far as having to hike rates as fast as we did, we're at a point now where, okay, if we're gonna flood the market with money and liquidity and backstops for these banks so they don't fail, then let's at least tighten a little bit on the back end as well. And so 25 basis points, obviously, Robin, that was of no surprise.
Yeah, I knew it was coming, man, but I just thought that the Fed would see the writing on the wall, what's going on with the banking system, and I thought they would have they would try to get ahead of the game, but they're just going to be reactionary with everything, and they're going to, and everything that they do has a lag and a delay to it. So by the time they react, it's going to be too late, right?
Yeah.
And so I'm just curious what this means for Bitcoin, right? In price action, right?
Well, Bitcoin right now is moving up. It's at 28,600. And so, gentlemen, glad to have you back. We lost internet for a second, but we are back. We're back. So 25 points. I know, Caleb, we got your opinion on this. You're expecting 25. Rob thought a pause was in play. I think all of us, we thought 25. Magic, were you surprised by 25 points? Is this what you were expecting? Or did you expect a pause or a cut?
I think I would have been more surprised with the pause personally, because that would have been more, to me, earth-shattering news. But to me, it was always going to either be a pause or 25 at that point. So we'll see what happens from here. But if there were some rumors they were going to cut rates, that was the only kind of elephant in the room. People were saying that they might even cut. I think that would have been a huge mistake personally. So yeah, no shocker. The market's doing what it does during the FOMC, though. It's wiped both the high side, took the new high, and then took the low. So wiped out both sides. So I think your question before this was, do we relish in this kind of price action? Sometimes yes, sometimes no. Price action like this that happens this fast, though, yeah, I'm not trying to jump into that and get in front of that train unless it's going to hit one of my specific levels.
Fair enough. What about you, Caleb? I know I kind of directed that question to you before we lost internet for a second. You know, I do know you look at charts, you do TA. I'm assuming you trade. What's your like? What's your what's the word we're looking for? Your not your thesis. Your plan going into stuff like FOMC, interest rate hikes, inflation numbers coming in. Are you kind of more of the stay on the sidelines, let's see what happens and then go in, or do you enjoy the volatility and say, hey, I can make a quick swing this way or a quick swing that way?
I wish I could say I enjoyed the volatility. I think anyone who says that they enjoy volatility is an absolute madman, but power to those people. I just know I'm not one of them.
Fair enough.
So for me, this is how I generally kind of approach kind of big macro events like this is, I definitely don't take trades going into them, but, I will hold positions if, I've had them for a couple of weeks or something like this, right? And that's for more of kind of, a shorter term kind of trading side of things. If it's more of like an actual investing decision, like, look, I was buying DCAing into stocks yesterday, right? So like, again, excuse my language, but like, I don't give a shit with, the Fed meeting or the GDP announcement, because it's gambling one way or the other, whether the market's going to go way up or way down. So I think you just kind of have to be agnostic. And if you see an opportunity in the market to DCA into a long-term high conviction asset, you have to do it irrespective of what's around the corner tomorrow or the next day, right? Because you never know.
Fair enough. Magic, can we quickly go to a Bitcoin chart real quick to kind of see what the price action is looking like, and then we'll get into some news on the banking, and then we'll be covering the press conference live here in about 20 minutes.
So this is your Bitcoin chart. I'm on the 1 minute, just so you guys know, just to kind of show you what I was talking about earlier when we were talking about, am I trying to trade this? No, you're not trying to trade this. I don't anyway. I know it's kind of like Caleb was saying, like, do you relish volatility? In some instances, yes, but when it's like this, it's, you should really wait and let the dust clear a little bit instead of trying to jump in. But what you're doing is, this is the original box we talked about that we had reached with those quarterly and 6-month values from last year. And you can see they're pretty well respected levels with our June 22nd summer low at 28,726. So this was your local high coming into the meeting. And I had taken the short from up here and closed out already coming into support. And what price had done was run lower back to your daily VWAP, your session VWAP, however you want to word it, and then came up, taking the high, taking the lows, and now you're just hanging out in the support. Now, for me, this is going to be one of those things where, as a high frequency trader, day trader, however you want to word it, I'm not really looking to get involved in this price unless it's either at my box up here or this box down below. And reason being is those are going to give me the best areas of invalidation for risk. And one of the big key areas just beneath us that, you want to see hanging on to see if we're going to challenge into this local box above us yet is going to be the weekly open. And so what you'll notice on the weekly open is that we've not run stops on traders getting long in quite some time. And there's been a lot of buyers up here. I would never refer to anyone as dumb money or smart money, but this is generally not smart money buying right here. So you can see some people draw a trend line. It's a really nice way to do it. But basically what you're doing is you're building up liquidity that if we start breaking down from these regions, that I'm probably going to see this area of the chart. I'm going to start running all of these stop losses where you can get that cascading quick move. And getting a quick move into a level of support that's predetermined like this, it offers up a really, really nice opportunity for the intraday trader, because then I've got invalidations, like here or here. Like, all I'm looking for is price to come below the level, reclaim it, see some trapped sellers down here, and I want to see buyers supporting the move, and then I want to take it back up to my next resistance. So very, very simple technical ideas. And then if that doesn't happen and we're right here, one could potentially look to long this to the box up here. Again, I'm not doing that personally, but their stop loss would have to be like down here or right here. And, it offers it up. I just don't think it's the smartest trade as of right now, seeing what we've got going on in terms of the order flow, and the order flow on this it's pretty clean, but it's so fast. in a move like this. And so I'm going to show you, I obviously watch things on the millions chart, meaning that every candle here is represented by 5 million volume, essentially, coming into the market. And you can see these are coming in. 5 million's entering the market in a matter of 4 seconds, 6 seconds. And this is a common theme. And you can see the open interest here. This is happening so quick right here that it can't even calculate the open interest for you. So that's generally a good sign that you're getting close to a bottom, though. And then you do see it catch up, and you see that 11.7 million people were washed out of the trade at the low after taking the high, and it resumes up here. And when you zoom in on the right side, you can see that you don't really have great buying imbalances coming in, meaning that this is more of a reactionary move. People are getting pushed out of position, so the market's just bouncing because it has to, so to speak, because people are being forced to buy. So they're being forced out of, or they're taking profits, I guess, in this case. So the market buys are coming in, but it's not actually increasing the open interest. So you see this happening, and it's just bouncing around. So this is stuff I don't get too involved in personally. Because it doesn't really offer up a great opportunity for the intraday trader. If you have a specific strategy for price action like this, though, maybe you disagree, but I don't personally. And so I stick and I play it kind of safe. I'm waiting for, I scalped this area quite a bit, waited for the high to be taken, got one really good short in. I'm going to let the federal, FOMC meeting do its thing, bring the volatility. And then when the dust settles, I'm going to be able to take a look at what opportunities are best. And I'm either going to get the trade this area of the chart, or I'm going to get the trade this area of the chart. And that's how I'm looking at it. This is the mid ground for me. I don't diddle in the middle. I think that's where you get chopped alive. So yeah, that's basically
awesome,
it.
Man. We do have, so we got the Fed statement out. Also, the Fed projections are calling just one more rate hike this year. Just one more. We can anticipate it to be 25. We'll see it at the next meeting. Which, and I'll show this real quick. I have a calendar of all the dates. So here are the remainder of the meetings that we have. So obviously, 21, 22nd is where we're at. We have 6 more meetings. This does not include any emergency meetings that they might call. Next one, we got to wait till May. Okay, May 2nd to 3rd. And then June, July. They take a much needed vacation in August. And then we have September, October. Well, you call it November. And then finally, December. Now, I want to share, we got the Fed statement that came in. And so this is kind of interesting. We'll get everyone's take on this. And guys, Jerome Powell will be speaking live in 17 minutes. We will be covering that, okay? So job gains have picked up in recent months and are running at a robust pace. The U.S. banking system is sound and resilient. Recent developments are likely to result in tighter credit conditions for households and businesses and to weigh on economic activity, hiring, and inflation. The extent of these effects is uncertain. The committee remains highly attentive to inflation risks. So what are your thoughts there? Okay. The banking system is tight. Well, there's some articles that disagree with that. The banking crisis threatens the Fed's inflation fight. Here's how. Collapse of Silicon Valley Bank, the second biggest bank failure in U.S. history, has thrust the financial system into distress, pulling attention away from separate problem, which is sky-high inflation. The twin economic challenges pose a dilemma for the Federal Reserve because the strongest tool, which is the interest rate, is a key cause of the financial emergency, but the primary solution for high prices. That's why people say they're stuck in between a rock and a hard place. The rapid rise in interest rates, however, tanked the value of bonds held by Silicon Valley Bank. And it talks about a continuation of the rate hikes will further intensify. You also have this. PacWest Banks has tapped their credit line after a 20% drop in deposits. So Pacific Western Bank said on Wednesday that customers have withdrawn 20% of their deposits since the start of the year, which is an issue because the current fractional reserve rate is zero. Is zero. You heard that right? Zero. For every $100 you deposit, they have to keep precisely none of that in cash reserves. The Los Angeles Bank also said it has raised $1.4 billion in cash from a investment firm, Atlas Partners, and they borrowed $15 billion from various Fed programs, including $2 billion from the new emergency lending program from the Federal Reserve. And then you had Janet Yellen saying this. I think I need to unmute. Yeah. It's just I need to unmute my thing real quick. So I'll play this video and then we'll get back and we'll get our expert's opinion here.
In your banking reg side of Treasury, any concerns over some of the stresses right now in bond markets particularly your Basel Holdings, Silicon Valley Bank, when mark to market. Are you picking up any data that we should be at least cognizant of?
Well, I will just say you mentioned
nice music
Silicon
going on
Valley
there.
Bank. There are recent developments that concern a few banks that I'm monitoring very carefully. And when banks experience financial losses, it is and should be a matter of concern.
What is this?
Meditation music. What is it?
Playing back there, buddy.
What is that music? Oh, I know what it is. It's this. It's this right here. I got this queued up for us. It's like, what is the music? Okay. So what did Yellen say? Okay. So because, sorry about that, you guys. My apologies. I had it muted because I have this queued up ready for Jerome Powell's press conference. But
I thought you were meditating over there watching that.
I was like, where's the music coming
the
from?
Fed is dropping bangers
puts
on their
yelling
live
on. He puts on some aquatic sounds, and he goes to bed, man.
Trying to seduce Miss Yellen to make her not destroy our entire banking system. But, of course, with Janet Yellen and company, they're not going to come out of here and say, hey, we're in peril. But do you think this bank run crumbling risk is over? Caleb, I'll start with you first.
No, I don't.
Wow. You care to expand?
I'll keep it simple.
Yeah, this is here. Okay, here I got a question for everybody here. It's a yes or a no. Are we in a financial crisis right now?
Hell yeah, we are.
Caleb, financial crisis?
I personally say no for now.
No. Okay.
Magic?
Yeah.
Are we in a financial crisis?
Not yet, but we're certainly laying the groundwork for it.
What about
If
you,
you want my
Robin?
personal opinion.
I think we are.
I
I
think we are, too.
think with the bank's insolvency issues, the few that we've already seen, I think there's actively more playing out. We see the Pac West, the Fed, First Republic as well. How many other banks are scrambling right now and are just leaning on the Fed in every way possible? I think that is happening in real time across the banking sector and across globally. I think we are in the midst of a financial crisis, and I think the Fed is trying to downplay it, and I think the U.S. Fed, the government's trying to. Downplay it.
Here's the question: is how long down the road? How many times can they kick this can down the road? Right? I mean, how long can it? Like, okay. And I was thinking about this yesterday. I was watching tons of videos on the Fed. I was like, okay, let's take a look at Do Kwon and Terra Luna, right? The guy got reckless. Okay. The guy got, his head grew this big, and it wasn't like his project failed. And it was Terra Luna's entire ecosystem, including UST, was north of $50 billion. And it completely collapsed. And the crypto market completely collapsed. But guess what? We're back. We're back to, well, not pre-Terra levels, but we're back up over 60, 70%. We didn't need anyone to come in and bail Terra Luna out, right? Because if you bail someone like Do Kwon out, he's just going to do the same thing. Because now it's like that kid that is bad with their money, that just knows I can go to mom or dad and ask for a loan, or a friend and ask for a loan. They're just going to keep making bad decisions. And so we're seeing that, like, that happens in every industry, right? Every country, every government, people take risks, they make bad decisions. And when it all crashes and burns, they're wiped out. And now they got to go back to the drawing board if they want to come back. And then others in the market, yes, they're affected, but they look at this guy and say, dude, that was terrible. Make sure I don't do that. But when you have a system that has mommy and daddy, which is the government and the Federal Reserve, to backstop and bail them out when they make mistakes, at some point, like, at what point are we going to say it's enough? It's enough. There's going to be pain one way or the other. What do you guys think about that? And whoever wants to go first can.
I'll take
Not all
it.
at once, guys.
Do I think that there's going to be pain? Is that what you're asking, basically?
Yeah, like at some point we need it's got to happen, right? Like if the government just continues to print money and the Fed and we keep raising the debt ceiling over and over and over, the word unlimited has been thrown into the conversation. It's like, at what point are we going to say we can't? Is it going to be the point where people just stop taking the dollar? Countries stop holding, like the dollar is no longer the reserve currency? Is that what?
We can all look at charts, and when you just keep going up, you know that you need to have a correction. And that's just what the Fed is trying to prevent in the U.S. government, is that they're trying to stop a natural correction. And so when is that going to come, you know? I don't know, man. I don't think it's ever going to come at this point.
You think it's ever going to come?
That's what I'm saying, man. It's like at some point there's supposed to be a correction, and every time there's financial stress and a company goes under or a bank's about to go under, they have to step in. And so we're absorbing the risks that these banks have taken and the failures of these banks, and we're absorbing it through inflation and printing. And
okay, like I said, there's pain. There's going to be pain, whether we're paying $50 for a gallon of milk.
That's the obvious answer. But the thing is like, the government's not prepared to let the economy pull into a 3 to 4 year recessionary period. They just say, hey, we can't have this. You know, the hardworking Americans can't go through this, so we're just going to print money. We can't let it happen. And if anything, if there was ever an opportunity, it would have been with SVB Bank, because there wasn't a lot of retail exposure. Now, it was just easily said, like, hey, like that could have been their avenue to have a realistic market correction, and sure would have spread, but I don't know. You know, here's a little clip I want to pull up real quick from this is from our shorts, but this just shows you, are we in a financial crisis? This is Treasury Secretary.
Just going to have to move on.
If we have a collapse of the banking system and its economic consequences, that will have very severe effects on banks in Oklahoma that will also be threatened.
I'm just worried about the long. I'm just worried about the long-term.
We are going to have to move on.
We're going to have to move on to, what do you think, Robin?
So the last thing she said was, if the banking system collapses, your state is screwed, right? That's essentially what she said. It's an interesting narrative from the Treasury Secretary. Like, let that sink in. How close are we to having a full-on meltdown that takes down an entire state's
Robin, pause it real quick.
rural banking system, right?
But that was before the whole, hey, yeah, we're looking at ways to cover every single deposit. So
no, that was after.
No,
they were talking about the bailouts going to the big banks. She was saying that. So the argument there was that,
what are you doing for the smaller banks?
What are you doing with the smaller banks? You've bailed out SVB. You're bailing out. You're offering a line of credit to the larger banks. You're not offering it to the smaller banks. And when she got pushed into a corner, she didn't say what she normally said. She got pushed into a corner, and she said, if the banking system collapses, like, how close are we? That's what I'm saying. Like, you got the Treasury Secretary testifying, and you're pushing her. She's like, hey, if the banking sector collapses, your banks are done. So we're doing what we're doing. And it just shows you, like, under pressure, people come out with the truth. And so I'm like, how close are we to collapsing? How close are we? Were we on the edge or the cusp?
We got super
and then
close
the Fed
last
stepped
week.
in last second? Like, I don't know.
Right, Caleb.
Yeah.
No, I think we got super close the weekend of Silicon Valley Bank. If that facility, if the BTFP was not announced that Sunday, not the one that we just had, but so literally a week and a half ago.
Yeah.
On Monday, it would have been a complete shit show. Oh my God. Because you have to think, like, we're all very plugged in on Twitter and the discussions around macro and finance and crypto. But the average American has, no differentiation between a regional bank, a community bank, or someone like JP Morgan, right? They're called GSIBs, global systemically important banks. And so, if most people had never heard of Silicon Valley Bank, I had never heard of Silicon Valley Bank, even though I was already working in finance until I moved to San Francisco and was working in finance. And so all of a sudden we're hearing about SVB getting shut down. If that facility wasn't announced that Sunday and the bank reopened on Monday, without that backstop there would have been a total run on the bank on Monday. And then what would have happened is average Americans would have been sitting at home on Monday, whether it was in the evening or in the afternoon, seeing all the mayhem going on and saying, wait, are my deposits safe? Right? And they're not well, so I'm sure I'm fine. Right? Because all people care about is the fact that the FDIC only insures up to $250,000 per depositor. Right. And so if someone's seeing someone, who had 500,000 at the bank and they're literally losing half of their deposits, that average American does not care that, this person, lost 250,000, but it was only at Silicon Valley Bank. It's just like, wait, I thought the banks were safe, right? So we literally could have had that scenario happen, literally last week. But, in a way, thankfully, the Fed stepped in. And I think they made the right decision to make that intervention because the role of the central bank is to be the lender of last resort, right? And so it just so happens to be the case that in the United States, our Federal Reserve has a dual mandate, which is for price stability and full/maximum employment. But at the end of the day, every central bank everywhere, regardless of which country it is intended to be the lender of last resort, right? Mm-hmm. And so that's what they stepped in to do that critical Sunday of SVB.
Okay, because I was going to ask you, do they make the right decision in Magic? You're kind of laughing. You think it was a bad idea to bail out that Silicon Valley Bank?
I made the mistake of reading the comments section. Oh, some guy he was like, I hope it doesn't collapse before my July vacation, and I was like, that's the most American thing I've ever heard. Like, they don't care about anything.
Already put the PTO.
Yeah. I got a July vacation too, actually. Yeah, but I have a feeling if it collapses, then definitely not going to have a vacation. So maybe. But I guess a lot of people, Caleb, you said it was a good thing that they bailed out the depositors. I want to make that clear, right? In 2008, what we saw bailouts, but that money went directly to the bank. And what the bank was supposed to do is lend more money, right? Create more lending facilities. And they didn't. They just bought back their own stock and pump up their stock price. I don't think we saw that with Silicon Valley Bank, because all it did was, hey, your money's there. You can pull it out now if you want. Magic, do you agree with Caleb that it was the right move to make over the weekend as Silicon Valley Bank was collapsing?
In the back of their mind, they knew they were going to have to do something like this at some point because they did historically raise rates very quickly. 75 basis points over and over. They knew they dropped the ball and should have been raising them well before that so that this didn't occur. So I think at some point, whether it was behind closed doors or maybe even just mentally, they knew that they were going to put quite a bit of stress on the banking system. And if something like this happened, that they may have to step in. So I think they made the right call because, again, it is a cascading thing. He is correct. I think once that, what do they call it? The contagion gets out. It's pretty hard to get under control at that point when the masses get it. But, they're putting a lot of stress on what we're doing now because they don't want to repeat of the 70s. And that's kind of what he said in the very beginning. It always goes back to that. Obviously we're not raising to the same degree where it's like we're going into like the double digit rates, but how quickly they're raising them or how quickly they did raise them. It was surprising to a lot of people, and I'm sure the banks are feeling it pretty hard. So, I wouldn't be surprised if they didn't raise this next meeting if the data came back favorably. They're going to have a few months now under their belts. Those 75 basis point hikes have all been in effect for a while. And if they're not having a positive effect on inflation by that time, I think we may have just got bigger problems. It's like, well, inflation's here to stay. Do we just accept it or what do we do? So
it'll be intriguing to see if the next month's CPI print for some reason comes in higher than the previous year over year. The bank crisis is still kind of, it's not like, oh my God, Armageddon, but it's not like, hey, everything's fine. What's the Fed going to do? Caleb, I want to ask you, you're very well versed in the bond market, treasuries. When we talk about Silicon Valley Bank and the reason they collapsed or the reason they had an issue, the liquidity issue, was because they were buying long dated. They were buying 2-year T-notes instead of 90-day T-bills. So longer to mature government treasuries, essentially. And a lot of people are saying, well, you knew they were hiking interest rates and you dumped $120 billion into long-dated maturities. And so why did you not hedge that interest rate risk?
The hedging is on.
Jerome Powell is live.
Well, I want to add that if
hold on.
Good afternoon. Banks,
Before discussing today's meeting, let me briefly address recent developments in the banking sector. In the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that all depositors' savings and the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. Turning to the broader economy and monetary policy, inflation remains too high and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories. Excluding those, core PCE prices rose 4.7%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5% next year, and 2.1% in 2025. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 4 3/4 to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation. And our policy decisions will reflect that assessment. In our SEP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what that participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.3% at the end of 2024, and 3.1% at the end of 2025. These are little changed from our December projections, reflecting offsetting factors. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation. We remain committed to bringing inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Okay. Rob, what are your thoughts on everything?
He came out first thing.
Banks.
He's like, I'm addressing the banks.
Yep.
Like, that's 100% different intro than anything else, right?
Oh, and I've never seen charts either in his, right?
Yeah. They publish those charts, but I haven't seen them now, not during the show. So forecasting 3% out 2 years on the interest rate. And so if they were to stay on that trajectory,
we're going to see a pivot before summer. I think we are.
It's a cutting, cutting.
Pivot or a pause?
He's saying that they're going to cut by
end of this year. Well, actually,
no, 5.1 by the end of the year. So he's saying they're not going to cut, and then they're going to cut next year, and next year they'll be down to 4%. The following year down to 3
point some. Caleb, what's your knee-jerk reaction to what you just heard?
Par for the course, no surprise there. I feel like the Fed has the ability to prepare these comments ahead of time And it's almost like read off the inflation data that we got 2 weeks ago as if no one remembers or that it's breaking news. But it's like everyone knows what the new inflation data was. We're continuing to see disinflationary dynamics. I think the big thing is, again, he did start out addressing the banking situation and just kind of generally providing a degree of reassurance to the market and to maybe even depositors, if you will, if they just see a headline that Federal Reserve Chairman reiterates support for deposits, right? Like in and of itself, that's going to do a lot of work, I think. And so, I think it was just pretty par for the course. I appreciated the rundown that he gave there on some of the SEP. I think the big thing for me, and I did a tweet about this when the data first came out, the interesting thing that I noted is that they revised higher their PCE inflation projection from 3.5 to 3.6%,
right.
But they decreased their real GDP growth for this year at the same time. So from my perspective, right, like the Fed has a Keynesian approach to economics and monetary policy wherein growth and inflation are positively correlated. So as growth goes up, inflation goes up. As growth goes down, inflation goes down. So how is it now that they're looking at a divergence in this relationship? And by the way, I don't necessarily agree with that Keynesian outlook. But it's just objectively how the Fed approaches things. And so it's interesting to see that they're actually revising higher their inflation expectations for this year relative to what their forecast was in December of 2022, while simultaneously revising lower their GDP growth expectations.
That's an interesting angle there. That's really.
Do you think they think it's just
Magic? What are your thoughts? And I know Bitcoin kind of is Bitcoin under 28K.
It was for a second, and it's back.
We'd love to kind of see the price action on Bitcoin, what it's kind of doing, and then what are your thoughts on what Jerome said?
So we just talked about a trend line, so that's what I drew in there so that we can illustrate where I was using the brush before. Now we're doing this, and you've come down to what? Right into the weekly open. There's your trend line. If this gives, then these stop losses become targets essentially. So you're wanting to see this hold if you want to see consolidation up here and a push higher still. That said, what he said was not surprising. Jerome kind of bores you out of your seat a little bit. He's not exactly the most charismatic guy, and he rarely says anything too earth-shattering. So he really did just kind of reiterate a lot of the things they've been saying in every meeting, in my opinion. But Caleb brought up the divergence. The only thing I could think of, as you're saying that, because I didn't catch that. I mean, you brought it to our attention, but it was maybe he's looking for some kind of a lag, that maybe he thinks that those effects won't take place till later and then they catch up. But it's not really shocking that they're sticking to their guns. He's more worried about stabilizing prices than he is potential crisis. So it tells me that in true Fed fashion, I think they're going to have to break something before they actually pivot. And if SVB wasn't breaking something, then we'll have to see something greater than that, obviously.
Yeah, it's definitely interesting to see how it's going to play out. Let's go back to the press conference. So if Jerome sounds like he's speaking faster, it's because I sped it up a little bit. So let's go ahead and listen to some of the questions he has, and we'll pause and then we'll discuss.
Thank you. Colby Smith with the Financial Times. How confident is the committee that the recent stress that we've seen and you've alluded to is contained at this point, and that deposit flight among mid-sized lenders in particular has ceased?
Thanks. So I guess our view is that the banking system is sound and it's resilient. It's got strong capital and liquidity. We took powerful actions with Treasury and the FDIC, which demonstrate that all depositors' savings are safe and that the banking system is safe. Deposit flows in the banking system have stabilized over the last week. And the last thing I'll say is that we're undertaking a thorough internal review that will identify where we can strengthen supervision and regulation.
Okay, just a quick follow-up. I mean, given all of the stress and the uncertainty that you've also alluded to in the statement, how seriously was a pause considered for this meeting?
So we did consider that in the days running up to the meeting, and you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected, and really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SEP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words. So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening of credit conditions for households and businesses and thereby weigh on demand, on the labor market, and on inflation. Such a tightening in financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever.
So,
man, he was saying that I call me crazy. 50 basis points was on the table, at least maybe not this one, but we're gonna ratchet up, and then
Can I
go ahead, Caleb.
I want to make a point on this because Friday morning when the SVB announcement came out, no one had really understood the magnitude of the SVB situation. But simultaneously to that SVB announcement of them being shut down, we also got the non-farm payroll data, right? Which gave us average hourly earnings. It gave us the unemployment rate. It gave us job creation. And when that report came out, we saw the labor force participation rate go up. The unemployment rate still ticks slightly higher to 3.6%, but it's still historically extremely, extremely strong. And we came in drastically above expectations for the second consecutive month in terms of jobs created. And I did a tweet immediately after that saying, I hope you like 50 basis point rate hikes, because based on that economic data purely, with the relatively stickier inflation data that we got in January, with a second extremely strong month for non-farm payroll data, JOLT still extremely high, the labor market was giving the Fed another green light. We had seen a resurgence in yields back to the upside. We were getting another green light fundamentally from the economy that the Fed could go forward with 50 bips again, right? And then the real magnitude of the SVB situation kicked in, and then the conversation around a pause started to happen. Right. So I love what he said there about how the Fed was fundamentally looking at economic data and saying a pure justification for going forward with 50 bips. But in light of the banking situation, in light of both domestically and abroad, the Fed is, decided to move forward with the 25 bips that they did in the last meeting. So again, a lot of people were talking about the credibility of the Fed going into this. I think their decision today actually, strengthens their credibility more so than damages it personally.
Do you agree, Magic and Robin?
I agree. I didn't want to see him pause or cut rates really, but 25 was the expectation. I think 50 would have been a bit of overkill after the banking thing, of course. But I mean, I kind of told people, going into this last couple of weeks, because it has been tumultuous in how people have viewed the market. We've gone from I expect 50 to now they're going to pause, maybe even cut rates, to now we got 25 today. I'm sure some people are shocked about that, but everybody wants to be right. To me, it's always been about risk and where I can find the best risk for my allocation, and just playing that game, because I can't predict what the Fed's going to do. I can't predict the job market. These aren't things that I'm capable of doing. And I don't know that there's too many people that are. So, I always tell people, make sure that if you are putting risk into the market, you're at least having some tact with it along the way, because data is data. Once it comes out, it's already priced in most cases.
Rob, what are your thoughts?
I'm not too much outside of what I first thought. Just so genuinely surprised for him to come out and say that they were looking to raise more aggressively outside of their expected target range. And it's basically what he was saying. He's been harping on this target range, and he just came out and he's like, you know what? We were about to raise the target range, and this happened. So
here's my issue. And I read the FOMC minutes, and I can't wait to read the next one. I cannot wait to read the FOMC minutes from today. But they knew that the banks were at risk with all these unrealized losses on their balance sheets, and they still were thinking about 50 basis points.
The thing is, they ignored the risk. That's the thing. It's like somebody walking into a casino. They know they can lose it all, but they're up, and they feel like they're the king here.
If you're going to break the banking system, and you're kind of like, okay, fine, then don't provide a backstop.
That's not how it works, though.
I'm just saying, like, you can't have both.
They are aware. We're
going to break the banking system, but we're going to provide them all the liquidity they need.
There's a risk to it, but they're arrogant and confident. They think that they can just keep par for the course, as they always say, and they need to get inflation down. And the economy's resilient. If something starts to crack, we'll throw some cement on there. I think they're always surprised by the outcome. They were surprised that inflation wasn't transitory and it came down. They were surprised that, they're always one step behind, man. And you know what? They keep raising interest rate now. All of a sudden, they're one step behind, realizing that the banking is where it was.
If you recall, they asked him about aggressively raising rates. Like, I can't remember when this was. It was sometime back in the summer when this is kicking off. And he said, if something breaks, we have the tools to fix it, essentially. That if we go too far, he said, we have the tools to fix it. So that's the approach they've been taking. And the other thing, the reason he made that comment today about 50 basis points is because he saw GameStop going up, GME, and he was like, I can't have it.
Yeah, I'm sure that's why. Keep an eye on GameStop. He's got like one board member. That's funny. Caleb, we know you got a packed schedule today, my friend. We really appreciate you joining us. We're going to let you go. We're going to give you the floor, my friend. Anything. Well, by the way, before I give you the floor, I want to give a shout out. You got over 4,650 subscribers to your Substack, Cubic Analytics. Maybe you want to talk about that. We do have a link to Caleb's Cubic Analytics. I believe there's a free version. There's also a paid version. But the amount of research this man does, if you're serious about investing, you're serious about learning, you got to invest in yourself. And so I'll kind of give you the floor, Caleb. Maybe speak on this and then whatever else you want to talk about, and then we'll kind of let you go.
Thank you, man. I really appreciate it. It's really awesome you guys gave that chart there. I am the worst salesman ever. So what I'm going to tell you guys to do is go sign up for my free newsletter. Okay. So it's cubicanalytics.substack.com. I call it Cubic Analytics because I take a 3-pillar approach to analyzing markets. We look at macro, we look at the stock market, and we look at Bitcoin. So if you're interested in one or all 3 of those things, there's going to be something in there for you. And it's a free newsletter. I publish it every single Saturday. I write it every Friday night. Regardless of what I have going on in my personal life, I literally do not miss. So if you like free research on any of those 3 topics, be sure to sign up. We're growing like absolutely crazy. I think I started the year around 2,700 total subscribers, and now we're basically closing in on 4,700. So it's been amazing to see word of mouth kind of pick up, and I'm always super appreciative of you guys at Sin City Crypto for, helping me to, use your guys' platform as a bit of a megaphone and try to share some value with your guys' audience. So it was a pleasure to be here today. Fed Day did not disappoint, and hopefully we still have some more fireworks yet to come.
Hey man, we feel like it's a fair trade-off. You bring us invaluable knowledge and information, and the least we can do is show people the resources that you put out there for people. And so, Caleb, we truly enjoy having you on, my friend. Thank you so much for joining us. You always bring the fire, amazing analytics and insight. So, guys, if you want some free info, or if you want to pay for some info as well, go use the link in the description of this video and go support the guests that join our show. Caleb, thank you so much, my friend. And we look forward to bringing you on again soon.
We'll do it very soon, guys. Enjoy the rest of your day. Peace.
Thanks, brother. Take care. All right. We still have Magic. We haven't let Magic. Well, let's go ahead and bring Magic.
What's going on,
Magic? Man? Hello. We want to keep it for a little longer if that's okay with you.
That's fine. Yeah.
Okay. So let's get back to our friend Jerome. And let's like maybe 1 or 2 more questions, and then we'll go from there. So here we go.
Our decision was to move ahead with a 25 basis point hike and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes, maybe some policy firming may be appropriate. So going forward, as I mentioned, in assessing the need for further hikes, we'll be focused, as always, on the incoming data and the evolving outlook, and in particular on our assessment of the actual and expected effects of credit tightening.
Mr. Chairman, can you explain the difference between ongoing rate increases and firming? Does firming imply a rate increase per se, or could policy firm without you increasing rates?
No, I think it's meant to refer to our policy rate. Really, I would focus on the words may and some, as opposed to ongoing. So we clearly what we were doing there was taking on board trying to reflect the uncertainty about what will happen. I mean, it's possible that this will turn out to have very modest effects. These events will turn out to be very, very modest effects on the economy, in which case, and inflation will continue to be strong, in which case, the path will might look different. It's also possible that this potential tightening will contribute significant tightening in credit conditions over time. And in principle, if that means that monetary policy may have less work to do, we simply don't know. So
Do you have concerns that the hike you did today could further exacerbate the problem in the banks?
No, I mean, with our monetary policy, we're really focused on macroeconomic outcomes. In particular, we're focused on this potential credit tightening and what can that produce in the way of tighter credit.
It'll be intriguing if we see a lot of defaults in the consumer credit, whether it's car loans, home loans. If we start seeing a lot of defaults and the banks are already struggling, and then bam, here we go.
There's a term that I think is now off the table and dead. Soft landing. Right? I think soft landing is that narrative is gone. It's now in the same wastebasket that transitory is in.
Wastebasket.
Right? It is. I'm telling you that if we didn't crash the market, but bless me, Lord, the wheels came down and then bye. Like everybody's hitting their head on the top of that luggage compartment above them. It was
one guy flying across the aisle. Magic, you were trying to say something. I think your mic was muted.
Oh no, I said it's definitely out the window. In that I would just classify it now as either a hard landing or a crash landing. Which one's it going to be?
What about a hard crash landing?
That sounds like the worst possible scenario. So no survivors in that one.
And I'll kind of wrap it up on this and get your guys' opinion. Do we need a complete reset? Like, do we need to just let whatever is over levered, whatever is just ready and is holding on by a thread, let it all come crashing down like Terra Luna did, like Celsius did, and let's rebuild from the ground up? Do you think that needs to happen? Magic, I'll start with you first.
Do I think it needs to happen? Nothing. I wouldn't say it needs to happen. I hope it doesn't, to a degree, because a lot of people are going to go through some pain that they're probably not prepared for. We know the average American's not. Nope. I'm a big believer in Bitcoin. I hold a ton of it, like probably more than I should. So I stay so active in the market to hedge against downside, things like that. But in that instance where I'm like, oh, well, I'm hedged in Bitcoin, how many people aren't? They don't have a lot of that asset where they could feel safe. So I don't want to see something like that. Do I think it's inevitable? It is one of those things where we're getting to the point, kind of like you were talking about earlier. Do I think it has to happen? It's inevitable if they keep going the route that they're going. You can only play this game for so long, and then there's cyclical crashes. And the question will be, what comes out of that? Not just from a financial system standpoint, but politically, because I think then that ties over to what's going on with our politics. People probably aren't getting along in the nation very well, worse than they are now.
Oh yeah, 100%. I mean, that's a fact. Here's the intriguing part too, guys, is we are going to get a financial crash at some point. Like there is, at some point, we're going to get a Fed chair that is not going to give a crap about quantitative easing, or that is not going to be swayed by the president coming in and saying, you need to cut rates. They're going to say, I am going to fix this thing if it is the last thing I do. And if I got to let a few banks fail, I will. So that might come.
It's definitely not a few banks. It's you let one, I guess you could call it medium-sized bank go under. They're all going to go as well. That paranoia is going to spread. Not only does information spread quicker as far as social media, the panic narrative can just shift through social media dangerously quick. But also, you can withdraw dangerously quick. You don't even have to go. In the past, with a bank run, you had to go down and line up at the bank. Now, all you got to do is open up that Wells Fargo or Bank of America app or that First Republic app. And so the rapid exit liquidity is at a dangerous level as far as how quick you can produce a bank run. One, on the narrative spreading. Two, on just the speed of withdraws. And then you ask, is there going to be a reset essentially? Is it inevitable? I would say this. There is a major market correction has to play out. Now, there's two ways it could play out. One is if a sharp hard reset, depression style, things just collapse and you rebuild from there. Or you just have a 10-year drawdown. The same way that the stock market grew for 10 years, maybe not quite 10 years or 7 or 8 years, but you gotta have a flushing of the system. Now, generally speaking, historically speaking, this typically happens in an abrupt fashion. Could happen in a more of a long-term way. But if in 1 year or 8 months from now or 14 months from now or whatever it is, if we're back to setting all-time highs in the S&P 500, watch out because it will reset. And it's getting more and more leveraged and getting more and more ugly every time we get into a financial tight spot.
Yeah. Guys, we are done. Magic, we want to thank you so much for joining us. We always appreciate you having on, my friend. We're gonna give you the stage here. If you want more Magic Internet Money, we have dropped a link in the description of this video to his YouTube channel at Magic Internet Money on YouTube. You can also follow him on Twitter as well. Magic, we'll give the floor to you, my friend. Anything you want to leave us with?
Always want to say thanks for having me on. I love this show. You guys have, I think, one of the best shows coming up in crypto and traditional markets because your guys' chat is always lit. I find myself gravitating toward it quite a bit. So, but in terms of what we're doing, like this morning, every day we're live for free. We go over order flow. We answer questions. We believe in no gatekeeping. So if you guys come in and have a question about technical analysis or order flow or trading, we're definitely going to go ahead and give you the answer that you want right there live on the spot, especially if we can answer it. So it's a great show. We're growing pretty quickly. I think we set a new high for people in the chat today on our show. Not nearly as high as yours, but we're getting there. So that is at 9 a.m. Central Time. Sometimes it starts at 9:15. So sometime in that window, it usually goes between 30 minutes and an hour. Tune in, follow me on Twitter. Love interacting with you guys. Don't take the memes too seriously. I do have a pretty good time with that and the thumbnails.
We love the memes, baby. Thank you for those kind words, man. And we love having you on. We love your insight. Our thing with our community is we want to present to them as many knowledgeable voices and analysts in our space so they're not in this vacuum of just hearing our opinion. And you're one of our go-tos. So we appreciate you, Magic. And guys, go check out Magic Internet Money if you want more TA fundamental analysis. I don't see any other TA analysts go over anything other than charts. Magic does order flows, which is extremely important. So it's another perspective you can gain. So definitely go check that out. Magic, as always, my friend, thank you so much. And we look forward to having you on again. Enjoy the rest of your day, and thank you.
Thanks, guys.
Take care. All right. Robin, any closing thoughts before we sign off?
Bitcoin's at 27.8.
Wow.
It's dumping, man.
What else is
that's
dumping?
the wrong horn, Rocco.
The wrong
the
chord?
trumpet. 27.8. So I don't know what the hell Jerome Powell said, but he must have said something there.
Yeah, we'll go check that out. Also, before I sign off, I just want to throw up.
Drop?
No, sorry. So, guys, here, let's show this. So, this is go follow Magic Internet Money at Magic Internet M1, not M2. And then for our other guest, Caleb, his Twitter handle is just his name, at Caleb Franzen. Also, you should go to ours as well. Ours is at Sin City Crypto 1. So with that being said, go check out all of our other social medias. All the links to everything you can ever ask for is in the description of this video. Also, before I sign off, we did release a video today. And so you guys should definitely go check that out. It was on the banking collapse and what it means. And so here's the video. And this is what it looks like. So I highly recommend you guys go check it out.
You want to create
beautiful ad there. Robin said he's gonna pay for a YouTube thing. But anyways, go check this out. It's got some great info in there. Titled Crypto Banking Collapse, the End of Crypto as We Know It. So go check that out. If you're not subscribed yet, subscribe. Check out that. Check that out. Check this out. Check this out. Finger tornado. Guys, thank you guys so much for tuning in. It was an absolute pleasure to join you and for you to join us on FOMC Day. On behalf of myself, Robin, and Rocco, we love you guys. Thank you so much. Shout out to our guests. Come back tomorrow. We have the Wolf of All Streets joining us at 10:30 a.m. Pacific Standard Time. Until then,
peace. Peace. Peace.